Welcome to the Macro Minutes Investment Show here on the Samaritan Financial YouTube channel. My name is John Burrell. I'm your strategy manager, and I'm here with IT Administrator Chadwick.
Hey, how are you?
I'm doing good. I hope you are. We just finished Thanksgiving yesterday. Today is Friday, Black Friday. So there's going to be a lot of deals and things out there, people getting out and going. So if you have a little bit of a drive, this is a perfect opportunity to listen to your favorite investment show on the internet.
All right. Yeah, that sounds like a great idea.
How was your Thanksgiving?
Oh, I had a great time. I got to spend some time with the family, got to eat some good food all around. 100%, 10 out of 10.
Heck yeah, we had a great Thanksgiving as well. We normally travel during the holidays, but this year we decided to stay around the house, and we had some great food, which I'll show on the screen right now.
That looks delicious.
Very much so. And with that, we're going to go to our market recap, the three main things that happened in the last week of markets. Mortgage rates fall sharply on expectations of a Fed rate cut. Will they continue from here? We are yet to find out, but historically, when the Fed starts cutting rates, they continue to cut rates all the way even down to zero before. And typically, a market recession follows, so that is something key to look out on. 2-year yield specifically is at 3.49, and the 10-year yield is at 4.01. Now these are the interest rates. They had been inverted, meaning the 10-year was below the 2-year for a long time. We're now uninverted, and the 2-year is below the 10-year. So we're looking for some normalization in that market. And with that being said, in the short term, it seems that when they first start cutting rates, money is more available, things are cheaper, it kind of stimulates the economy. And we do see, especially right now, we see a rebound in market based on the Fed expectations of a rate cut. So markets have rebounded. The NASDAQ is on its way back up from its recent pullback, but stocks like Nvidia are still down off of its all-time highs. Moving on to some more world news, UK retailers' confidence collapsed to a 17-year low before a budget. In the UK, they're looking at increasing taxes, which will definitely take money out of people's pockets, especially if they do it before the holidays. Or even after the holidays, next year's growth expectations tend to decline going into 2026. Moving on to see how this has affected our charts and our trend levels. Looking at the S&P 500 is currently at 6,859. Our trend level is at 6,072. So we're looking to buy above this blue line here, this blue dashed line, and sell below it. So we're going to keep tight risk management, and we are going to still lock in the upside profits. Moving to the NASDAQ is currently at 25,482. Our trend level for that is 21,804. Once again, like the S&P 500, the NASDAQ is bullish trend. Moving to something that isn't bullish trend, but is actually bearish trend, which is crude oil. Crude oil is currently at $58.55 a barrel. And our trend level is all the way up at $71.37. So we would not be buying this market until it would get above our trend level. So this is something that our strategy is staying out of. Moving on to gold. Now our strategy got into gold months ago, and it has done very well. Gold is currently at $4,254 an ounce, and our trend level is right around $3,000. It's at $2,928. And it has a massive tear to the upside. Moving to silver, silver is at $57.16 an ounce, and its trend level is $32.78. So massive runs for the strategy on both of those precious metals. Moving on to Bitcoin, a lot of talks of Bitcoin in the news lately. It's currently at 91,065. Our trend level for that is at 97,395. It is bearish trend, just like crude oil, for one of the few bearish trends we have in the main markets that we look at. Now we're going to look at our proprietary trading strategy, the S&P 500 total replacement strategy. So if you're investing in the S&P 500, this is a product that I would like you to look at to see if you'd be interested in. What we aim to do in this is to reduce the drawdown of the S&P 500 but still capture the upside gains. We're currently down 1.4%, and as you can see, the dashed line is the S&P 500, and the green line is our S&P 500 total replacement strategy. We are currently just below performance of the S&P 500, and we're managing this for when we get bigger pullbacks, but right now we're right in line with the S&P 500. If you'd like to subscribe to the strategy and get all of the strategies, alerts, and trades that we make, you can use the link in the description. You will get $5 a month for 3 months for the strategy signals. Now, if you want to automate that strategy in your brokerage account and be hands-off, you can automate it for additional $55 a month. We're strategy managers here at Ep.2. We manage this strategy for them specifically. And with that, we are going to move over to our educational corner.
All right. Well, this is absolutely my favorite part of the show.
Yeah, well, we're going to dive in some key concepts, and we're just going to continue to build off of it from the previous week. Last week, we talked about how important liquidity was and only investing or trading in markets that are liquid where you can get in and out easily. Now, liquidity is basically having a lot of buyers and sellers. If you want a review, you can go to last week's episode and have the full breakdown where we talk about liquidity. This week, we're going to continue to build on our main investing concepts. This week, we're going to talk about position sizing. Now, position sizing is the most important thing that you can control. You can't control liquidity, even though it's the most important thing, but you can control your position sizing. Now, you can do this in a very different ways. A lot of people really don't have a black and white approach to using their position sizing. They just kind of go off a feel or gut instinct. But we do quantitative research here, and we like to come up with a exact number that you can hang your hat on. So, with that being said, we are going to move over to the graph that we have today. Now, on the bottom of the graph, you have the fraction of the bankroll that you use, or the fraction of your account per trade or investment. On the left-hand side, it's going to show the expected log growth of your portfolio. So all the way on the left-hand side, you are taking zero risk and making zero return right here. As you move horizontally to the right, you take on more risk. And as the graph goes up or vertically, you make more money. So let's say you use 10% of your account for the strategy. Now, the strategy that we're using in this example has a Keller criterion edge of 20%. That's the amount that you're going to make over time using this strategy based on its advantage. Now, the 10% allocation would gain you a 15% return, while a 20% would gain you a 20% return. And while a 30% allocation of your bankroll would only gain you 15% like the 10. So as you can see, there's a sweet spot of taking risk and reward, or risk versus the profits that you're making.
Okay, well, it kind of reminds me of when I have to hang a picture on the wall. You know, a little to the left, a little to the right. You want it exactly even. So that's right where the Kelly criteria, that's where it's at.
Yeah, it's right at the center where you're taking the optimal amount of risk for the profits that you can make. Okay. Too far to the left, and you're taking less risk. Which, if you're less risk, if you're risk adverse, taking less risk, but you can still make some money, that's fine. But what you really want to watch out for is when you take more risk and you make less money as well.
Right. That's when you start to get into the red.
Yeah, you're making money, but you're taking way more risk to make the same amount of money as if you just took less risk. So if you want to optimize and you really want to shoot for things, going all in is not the answer. It's really understanding the math behind the strategy that you're using.
Or getting around the curve, you could say.
Yeah, getting around the curve.
You go.
You want to stay right at the top of the peak of that. And with that being said, that's our educational corner this week. If you have any questions, please leave them in the comments section below, and we'll get to those as much as possible. Now, with the holidays just passes on Thursday. Today is Friday, Black Friday. There's going to be a lot of shopping and people out during this time of year. So if you go out, please be careful.
Right. You know what? The markets are starting to act like they're waiting on their own holiday sales. Investors are starting to pile in. They're wanting their rate cut discounts, you know. But the funny thing is, the only thing that's really going on sale these days is their dignity.
Yeah, with that, we have had a lot of movements in the market, and people seem to freak out just over a 5% pullback in the market.
Right.
But you have to stick to the strategy and not to your emotions. And with that, it's been the Macro Investment Show here on the Samaritan Financial YouTube channel. We will see you next week.
All right, and just like I say, stick with it.